us right now is Joe Amato. He's the president and chief investment officer at Neuberger Berman Group. Take a deep breath. What was yesterday like for you, and what do you think today is going to
I thought this was going to be a run-of-the-mill Tuesday and talk about the Olympics or something, and a quiet summer morning, and quite a market over the course of the last couple of days, and clearly a violent unwind of a lot of positioning over the course of the last couple of days. We still think the underlying fundamentals of the economy are sound, although signs of weakening clearly. So I think you're going to continue to see a bit of chop as this unwind continues. It doesn't unwind in a day, right? It takes a bit of time.
So we've been talking about what that unwind looks like. Some of the unwind, by the way, happening in Japan. That seems to be a huge component, part of this. Absolutely. But are you thinking to yourself when clients call, as I'm sure they did yesterday, and say, either should I be selling, or maybe more importantly, I've got some cash on the sideline, should we be buying into this market? You're telling them what?
Well, I think your point around cash is really important, because we think that the Fed's going to move rapidly over the course of the next 6 months or so, right? The market right now is pricing in roughly, 120 or so basis points of reduction in the Fed funds rate. So those who have been earning 5.5% in cash are going to start to earn a lot less than that. So starting to put money to work as you see this rate cut cycle begin. You see inflation coming down. It may not necessarily get to the target level, but clearly it's come down. So I think you want to start to put money to work as we move into the next phase of the cycle.
We keep talking about August and what it portends for October. October is always one of these months that makes you either super anxious.
I remember October '87
way off too. There's a lot of scary days.
But if you think that there's going to be chop between now and then, what are you doing? I mean, there's some people who might just sit on their hands.
Yeah, look, I think you take advantage of these opportunities that get presented to you. So if you think about Japan, we've been bullish on Japan. When you see that kind of decline, now granted it was up 10% overnight, but nonetheless, we think Japan is a very long-term attractive market. There's a lot of important secular changes going on in Japan as companies drive higher levels of shareholder return. So you take advantage of that. Many clients have told us when we've been talking about Japan that, oh, we missed that, right? It's been the best performing equity market in the last 3 years. And then you have an opportunity that came about over the course of the last couple of days to put money to work and invest for a longer term.
How do you think about bonds right now?
We think that the sort of fair value for the 10-year right now is still around that 4.25 level, right? So this, when I walked in here, was what, 385 or so. So we think rates are going to move up a little bit. So we've shortened duration in the context of our fixed income portfolios. But if you look at long-term inflation expectations, real rates, term premium, we think around 4.25 for the 10-year is fair value.
How much should we like or not the banks right now? And the reason I was thinking about the banks is just, I mean, they're not even in the mortgage business anymore, but there is commercial real estate out there, and there's big questions as to what's really going on there.
Look, the financial sector has changed, of course, a lot over the course of the last 20 years, right? The 2007-8 period is still embedded in all of our memory banks, particularly us.
Yes.
But I think the soundness of the financial system is clearly improved over the course of that period of time. So I think the banks, you know, in an economy, if you go back to the comment I made around the foundation of the economy being relatively sound, right? There's some cracks, right? If you look at quarterly earnings out of some of the consumer companies, right? They talked about, you know, some concerns about consumer spending, particularly at the lower end. But nonetheless, I think the system is sound and the economy is there. So from a credit standpoint, the bank should be okay.
And then finally, what do you tell your clients who call up and say, do I still want to own NVIDIA or not? Right? I mean, this is the AI play. Also Apple. I mean, all of these things. That's the hardest part about this whole situation right now.
These stocks have moved an enormous amount. As much as people are like, oh, my God, NVIDIA is down 6%. It was up 100% still this year, just this year, right? So look, these are amazing, high-quality companies that have delivered extraordinary returns over the course of the last number of years. We think there's going to be a broadening out. And you start to move into a rate cut cycle, that broadening out is going to be important. So the narrowness of the market leadership that we've seen, which has been a concern of ours and a concern of a lot of folks, we think you want to broaden out. You want to have more exposure to cyclicals, not just stick with growth. And I think you want to move into lower cap sizes that have clearly underperformed over the course of the last few years.